Welcome to Options for Income. I'm Don Singletary, and you're about to see and learn a very specific strategy that professional traders in the know have used for years to generate reliable income. Warren Buffett said that if you don't learn to make money while you're sleeping, you're going to work until the day you die. And today we're going to be talking about how to create a source of second income, regularly recurrent income, monthly, by selling options. And to do it, we'll use some of the same technology that we use to navigate these days, and we'll be using broadband internet, discount commissions, and the same math that insurance companies and casinos use to make themselves two of the most money-making businesses in the world. So stand by. Let's get started. The most money-making game in a casino are the slot machines. Also happens to be about the easiest to play, too. Every single slot machine in the state of Nevada profits $240 a day. Now, these slot machines, maybe what you don't know is they pay out about 98% of the money they take in, but they keep that 2%. And the longer they can keep you there playing, the more money they're going to make. And I'd rather be the house than the gambler in any casino any day. What you and I need to know is how to apply that kind of math so we can become as profitable as the gaming industry. Most people think life insurance companies make money because of the actuarial tables. But the truth is 90%, 9 of 10 of these life insurance policies expire with never paying a benefit because they're allowed to lapse. With those kinds of odds, no wonder the insurance company is a money-making business. Now, similarly, 80% of stock and commodity options expire worthless, which is exactly why you should be a seller of options and not a buyer. In selling options, I look for a high probability and ultra-low delta trade. A lot of option traders don't realize the mathematical relationship between these two. For example, a delta of 0.1 translates to a 90% chance the option expires worthless. A delta of 0.05 is a 95% chance of the option expiring worthless. And that's one of the ways you keep the odds in your favor on these trades. There are definite advantages to being an option seller instead of a buyer. A buyer has to get 3 things right every time to make money: price direction, price amplitude, and the timing. It's a pretty small target to try to hit. On the other hand, as an option seller, it's like you can throw anywhere on the board because the only thing you have to do is to guess where prices won't go during a certain time. And this gives you a very high probability, low delta trade. Next, we're going to take a look at the characteristics between trading a stock market and trading a commodity market. You know, it doesn't matter how good your stock picking skills are, your stocks are going to rise and fall with the larger stock market whims. Stock market volatility, the tide that raises and lowers all boats. Another thing about stock prices is that they sell for a multiple of their earnings. That's an abstract value. Commodities, on the other hand, are sold for face value, 1-to-1, a barrel of oil, a bushel of corn, an ounce of gold, or a gallon of gas. Their value is physical and not abstract and will never go to zero. You've got lower margins and higher leverage through a special thing that applies to commodity trading only. It's called span minimum margin requirements. You get more bang for the buck and a much higher return on investment. Not all, but most option traders that trade commodity options come from a stock option trading background. So that's why I want to show you a comparison between the two. Up here I have a Disney trade. Disney is currently trading at $115 a share, and I've written a 130 strike call, and the premium I get credited to my account is $57. Now, the margin requirement for this trade is $1,154, and the option expires in 118 days. This particular trade would have a return on investment, if successful, of 4.9%. And the probability of profit for this short Disney option is 90%. It's not a bad trade. Now I want to be able to compare the difference between the two, the stock option on the left and the commodity futures option on the right with gold. You'll see the margin requirements are much more for the Disney. Expiration time is about the same in both trades. The Disney returns 4.9, the gold 28.8. The probability of profit 90% on Disney, but even higher, 95.85% on the gold trade. Now we need to take a look at exactly why we can get more leverage with a commodity trade like this than we can with a comparable stock option. The answer is an algorithm, a word we're getting more and more familiar with in the 21st century, one of those things computers do with math formulas and sometimes conditional logic statements. Now, the algorithm that the markets use in trading commodities and commodity options is called a span minimum, the span minimum margin requirements. It's standardized portfolio analysis, and the main inputs to it are strike prices, risk-free interest rates, changes in prices on the underlying securities, changes in volatility, and decreases in time until expiration. So if somebody asks you what span minimum means, that's it. Now, the good news for you and me is we don't have to compute it at all. It shows right on your trading platform, your trading software. Right before you enter a trade, it tells you exactly what the net effect on your margin requirements are for the trade. Now, for this example, we're selling this $1,500 an ounce gold call. We'll use the daily chart for the June 2019 gold futures. Zooming in, we see that gold last closed at about $1,336 an ounce. That's $164 below our strike price of $1,500. We're selling the $1,500 an ounce call, and we're going to sell it for 1.8, which is $180. Note that it's 94 days, about 3 months until expiration. One other big number on a trade like this is the probability the option will expire out of the money. You see it written on the screen there, the PROBOTM, probability the option will expire out of the money, which means it will expire worthless in 94 days. It's 95.85%. Another algorithm that's based on the Black-Scholes option formula computes this number for you. It too will be in your software, or I can show you how to find it easily at a later time in another video. But 95.85%, that's based on the current price of the underlying, its volatility, interest rates, the distance the price is from the strike, and the number of days until expiration. So if at expiration gold prices are anywhere below $1,500 an ounce for gold, the trade's a winner, and it has a great high probability of success. But what usually happens is we close out these trades before the option expires. And the reason is simple. If we have a nice profit in the trade, we don't want to hold it longer and risk giving that profit back in order to make just a little bit of money that might be left by holding the trade. It's a simple decision. I'd like to share a quick story with you about how I found out that most personal investors actually have the same problems in trying to make money, and also about how I accidentally became a writer of financial books. One Friday morning, I had breakfast with a friend. It was a regular Friday thing we did on an early morning, and he happened to bring a folder with him. He knew I had worked in options for 25 years as a commodity risk management hedge consultant. And so he said, I've got this thing I'm thinking about ordering. In fact, I'm sure I'm going to go ahead and order it. It's a fellow who's a trade advisor, and his service is only $3,000 a year. And then he held up the folder in his lap, and he said, take a look at this, will you, and tell me what you think. So I looked at the folder, and like I said, I've got a lot of experience with options. So I saw quickly that basically the guy was only using 3 strategies that aren't that complicated. And I grabbed some napkins out of the container on the table and explained to my friend in the next 20 minutes, writing on the napkins with my flare pen, about how these strategies worked. And he said, well, I guess you just saved me $3,000. And he said, you know, you should really write a book about this. And I said, no, I think 25 years time I did with nothing but options every day, that's enough. I think I'll take a break. Anyway, I got home later that day, and woke up the next morning on Saturday, and by sundown I had written this short 55, 60-page little book. And just as a joke, I had written it in the word processor, and I converted it over to a Kindle book I uploaded it to an Amazon bookstore, and I made a little cover for the book, and I sent an email to my friend and told him he could buy all the things I drew on the napkins for 99 cents on Kindle. And he laughed and he said, "That's a good idea. So you did write the book." And I did, actually. And what I didn't expect, I was blown away, that little 99-cent book made from the napkin notes sold over 400 copies in the next 2 weeks. And I said, wow, investors really do have an interest in this subject. So I wound up writing a longer book on options and did a much better job with it and took the small 99-cent book away. But that's how I became a financial writer, and it's also how I learned that investors really, for the most part, have the same problems in trying to find ways to invest their money and to do it without taking too much risk. Now, I can't say that this type of trading is going to be suitable for you because I don't know you, but you can find out without risking a dime. Go to timefarming.com. You'll get email notifications of my trades the same day I make the trades. You get marked trade charts like some you saw at the beginning of this video. And also you'll have the research links library and the full commentary. I publish the how and why of every single trade that I make. Perhaps most importantly, you'll get trade management techniques. You'll see when I put on a trade, when I take a profit, when a trade goes bad, how do you get out of it? How do you handle losses? There's a lot of information in this portion called trade management, and you get access to my video training library. You'll also be learning many of the trading tips in my 2 books on this type of trading, time farming and seasonal commodity trading. You have nothing to lose, no debit or credit card required. You can sign up for the free 60-day trial just by going to timefarming.com. This is your official invitation to join me, and I hope you'll consider it. This is Don Singletary, and thank you.